This is the Clear Money Talk podcast, offering up creative solutions for your retirement future through education, choice, transparency, and empathy. Now, your host, CEO and founder of Clear Financial Partners, Tim Clairmont, and co-host, Tyler Andrews.
Hello. My name is Tim Clairmont. I'm the CEO and founder of Clear Financial Partners. Welcome to Clear Money Talk. And as always, here with our co-host, Mr. Tyler Andrews.
Thank you, Tim. Welcome to the podcast.
That's right. We have, this is our last, as Tyler and I were just chatting, this is our last YouTube recording on a inferior quality camera. We will be upgrading the camera for our next one. So as you watch this in whatever capacity you watch this in, hopefully the next show will be even better.
Hopefully the next one will be in 1080p, not
right.
720.
Yeah, right.
But this will be fun. It will show the progression of Clear Money Talk over time and our dedication to the podcast to give you guys the best quality possible.
Yeah.
You know, both for content and for viewing ability.
That's fair.
We're doing this for you.
That's right. So hopefully you enjoy this retro experience. So,
yeah.
All right. What do we have today? As always, I have no idea what the topic is. We're going to find out. Tyler's going to ask the money question. You know what it is already because you clicked this before you had a chance to watch it. You know what the money question is. You know what I'm going to be answering today, but I have no idea what the question is. So what's the question? What are we talking about?
Are you maximizing your tax return this year?
Oh, I'm going to nerd out on this one.
I know you are.
Are you maximizing your tax return this year? Oh, that's going to be fun. That's going to be fun.
We are. It is tax time is upon us right now. Likely when this podcast comes out, you will have missed out on the opportunity to take advantage of anything we talk about. However, you could use it for next year, and you can set yourself up for long success because you'll have a full 12 months before next year's tax time rolls around the corner.
That's right. So we'll try to see if we can give you some insights. By the time you're listening to this, the tax return filing deadline will likely have already passed. If you filed an extension, there may still be a couple of last minute things you can do before you file your actual return. But as Tyler said, don't beat yourselves up over anything you might have missed out on. Let's take a look ahead and see what you might be able to take advantage of for 2025 and make sure we don't miss out in the future. Plus, there are ways to actually amend your tax return. You can go back as much as 3 years and amend your return. So if you missed something you actually did and you just didn't report it correctly, you could go back and amend that return and fix that to increase your refund or maybe decrease the amount of money that you might have owed. Again, of course, legally reducing your taxes is what we're about. So any insights that will help you pay the legal minimum, that's one of the things that we're always striving towards. Tyler's so on point though with this comment about teeing me up. Some say that it's like he set up the tee and then put the ball on it and said, "All right, Tim, go to town.
Go ahead and hit it."
The analogy that I'm thinking though in my head, if you've ever seen those monkeys that have the little cymbals that like clap together, I feel like I have like a little tiny, that little white knob that you spin and you max it out, and then it like internally has like a winding clock. Stuff like if you go to the max, all of a sudden it moves really fast. I feel like that monkey right now because Tyler just said, hey, taxes. That's
Energizer Bunny.
Oh man, I'm so excited. So excited to talk to you guys about taxes.
Let's start simple and let's get more complicated with this one.
I like that approach. Let's start simple and get more complicated.
We have a whole walk of different listeners, viewing our podcast, which we love and we appreciate. Thank you for being here. But some viewers might not know what even a tax return is. What does that mean?
Oh, wow. Yeah, sure. Okay.
Let's start at the basic. Like, what does it mean to get a tax return or to file your taxes?
Yeah, no, that really is smart. So, let's go there. When you earn income in the United States, and you have this income stream that you have come in, the IRS Internal Revenue Service collects a portion of your income that they use to pay for all the public services. Obviously, this pays for roads and teachers and firefighters and police officers, our military, pretty much anything that is considered a public service. Our parks are taking care of that. There's a laundry list of things that they pay for. Yeah. Admittedly, a lot of people have expressed frustration over how the government spends the tax dollars, and that's not something we're going to get into as much on this podcast, though I'm sure that would be another entertaining podcast that we could talk about another time.
Podcast for the future idea. Write that down, Tyler.
Future idea, that's right. But as far as taxes are concerned, what taxes really are when you file your tax return is it's an annual true-up. That's the best way I can articulate it. It's a true-up. You prepay an estimate every time you get a paycheck when your employer withholds the amount of money for federal taxes for you. And then at the end of the year, you get that W-2 that says, here's how much money was withheld for taxes for federal. And if you live in the state of Oregon or the state of California or another state that has a state income tax, they also withhold for state income taxes. So in Oregon, we have the Oregon Department of Revenue that collects approximately 9%. California, the California Department of Revenue collects approximately 10% of your annual revenue, in addition to what the federal government receives. And so your employer will typically withhold for both federal and state income taxes. And then at the end of the year, you get that information on your W-2, and you do your tax return so you can see what you actually owed. So think of your tax return as the true bill that you owe the government. And when you complete that true bill, then they compare it to what you paid. If you prepaid your estimates higher than the actual bill ended up being, you get a refund. They send you money back. If you prepaid your estimates lower than the amount that you actually owe, then you have to write them a check. And if you have to write them a check, for the federal government at least, that's over $1,000, most of the time you also get hit with interest because they wanted you to have prepaid that the previous year, not pay that when you file your tax return. And so you want to, generally speaking, people want to owe less than $1,000 in their tax bill or get a small refund back. On the other hand, if you get a very large refund back, that means the government was sitting on your money all of that last year when you prepaid those estimated taxes, and you didn't owe them that money, and you didn't get any interest on that money. So you don't want to get a huge refund. If you get a huge refund, then you were missing out on interest you could have otherwise earned if that money was somewhere else. So that's a basic, kind of what a tax return is. And as you think about that, think of that as that annual true up. Getting a refund and owing money isn't some indication of tremendous success for you and everything. It's how much you prepaid in term the previous year. A lot of people I feel like when they get the refund, like that's a win, and all that means is that you overpaid the previous year. So at the end of the day, getting the lowest invoice in your tax return, that's the win. How do you get the lowest total taxes owed for the year? And then hopefully that's comparable to what you prepaid. But I would say that get the win, decrease that actual true up bill at the end of the year legally to the minimum, and that's really where I would encourage you to focus your energy. I find a lot of people are focusing it on, do I get a refund this year? And it's really misplaced.
We'll go next there actually. So a lot of the next talking points I have for the podcast is to talk about how do I lower my invoice. But I want to pivot back to what you said. Very interesting stuff. Thank you for sharing all that.
Yeah.
I knew this podcast was going to be good because Tim Clairmont is talking about taxes. That's always a good time. But it doesn't sound like it's a two-way road with you and the government. They want you to pay interest and penalties and taxes and all this stuff. But if you give them too much, you don't get anything for that.
That's right.
IRS, if you're listening,
you do actually collect. You can collect interest from the IRS, and here's how this works. It's only if they are slow to pay you back money. Oh. So if you file a refund or an amended tax return that says you're due money from them, and they get you that money back fairly quickly, if they get it back to you within, I can't tell you what the hard cutoff is. I feel like it's like 45 days or 90 days, something like that.
Sounds
if
about
they
right.
Get it back to you within 45 or 90 days, whatever it is, then they don't owe you interest. If it's normal timeframes. If it was an error in an amended tax return, there may be some interest involved there. You'll want to talk to your accountant or your tax professional to verify that. But if they're slow to pay you, if they pay you, if they just don't get around to sending you the money that they're owed, and it takes a while, but they actually have to pay you with interest as well.
Good.
So there is a way to collect interest, but not on your annual routine estimated tax payments and withholdings that come out of your paychecks. When you do your true up, you're not going to get interest on money you overpaid as far as a refund when you just do your regular annual filing.
Got it. I wonder what the largest tax refund has ever been.
Oh, that would be interesting. I bet that's Googleable or ChatGPTable.
Yeah. Look it up. Let us know. Give us a call. Let us know what that is.
Yeah, the largest tax refund.
Yeah, I'm curious.
Okay.
Okay, next is let's talk about common tax deductions and credits.
Okay.
So that's a common way that many taxpayers will choose to see if they qualify for any of those options, whether it's a deduction or a credit. And maybe Tim can talk about the pros and the cons of deductions versus credit, which is better, which ones you want to try to get. But those things help to reduce your taxable income. And I think that's what you were hinting on just a few minutes earlier, Tim, is trying to lower your taxable income as low as legally possible while not sacrificing, income still at the same time, but trying to basically show the government that you earned the lowest amount of income possible, so that way you end up owing the least amount possible.
Yep. So we're going to talk tax deductions versus tax credits in a second, and I'll give you a little clarity on what the difference is between the two. But before we go there, I realize there's something else I need to communicate to you first, and that's the three ways that people can help you with taxes, and what we do and what we don't do. Because one of those three things we don't do. The other two things we actually do work on with our clients. The one we don't do is tax preparation. So filling out your tax return for you, defending you in an audit with the IRS or the Oregon or California Department of Revenue or whatever state revenue. We don't do that. We're not accountants. We're not out to replace your accountants. If you've got a great accountant, wonderful. We'd love to work together with your accountant. If you are your own accountant, that's great. You can keep doing your own taxes. That's not what we do. We do, however, handle tax planning, and we'll look at tax planning together with our clients as well as with their accountants, and we strategize together overall, how do we pay the lowest amount of lifetime taxes? Not just income taxes this year, but if we look ahead at all the years ahead projected for the rest of your life, how do we take that big picture and say, how do we minimize the overall amount of taxation that you're going to experience over your lifetime? And then we'll even look past that and say, when you pass assets on to your family, how do we make sure that we minimize the tax consequences for them as well? That's all tax planning, and that's very much one of the things that we work with our clients on. The third piece that we do is tax management. So when you have a portfolio that's invested that is subject to taxation every year, we actually will manage that portfolio with the intentionality of minimizing your income taxes. And that might mean holding some positions to make sure they incur long-term capital gains instead of short-term capital gains. It might also mean doing something called tax loss harvesting or tax deduction creation, where we try to create some legitimate tax deductions for you by repositioning your portfolio near the end of the year. That's tax management. So those three different things: tax preparation, tax planning, and tax management. We definitely do tax management for our clients who have assets invested with us. We definitely discuss tax planning strategies together with our clients and focus on lifetime minimum taxation. We do not do tax preparation. So just to be clear on those three things. Now let's go to tax deductions versus tax credits, because that's where we left off. So tax deductions versus tax credits. I want you to imagine that you have $100,000 a year of income, just because it's a nice round number. It makes it easy to figure this out. So let's say you had $100,000 of income this year. And before you go to fill out your true-up, your annual tax return, you're going to say, okay, what are my tax deductions? Now, if you had a tax deduction of, say, $10,000 as an example, then you get to magically erase $10,000, make it invisible to the IRS, and only have to pay taxes on $90,000 in this example. By doing that, if your tax bracket is 12% federally as an example, on that $10,000, you'll have saved $1,200 in federal taxes. Now, if you're also in the state of Oregon and you have 9% income taxes, you'll have saved an additional $900 in Oregon income taxes, saving a total of $2,100 on that $10,000 tax deduction. Pretty valuable, right? $10,000 tax deduction saves you $2,100 in that example. Now, the higher your income is, the more tax savings you experience. So if your income was, for example, $200,000, your tax bracket federally is probably closer to 24%. It's possible if your income's even higher, you could be in the 31, 33, or even 37% brackets. I think we still have 37 right now. Or is it
we do.
Yeah. So imagine if you're in the 37% bracket plus 9 in the state of Oregon, now you have 46% that's owed to the IRS and the Oregon Department of Revenue as an example. That same $10,000 tax deduction for you is worth $4,600 in tax savings. So still way more valuable than the $2,100, but still extremely valuable, that tax deduction. Even then, a tax deduction is not as valuable as a tax credit. Tax credits are fewer and further between. They're more rare. If you have a $10,000 tax credit, that's actually $10,000 off your actual tax bill at the end. So it's a $10,000 tax credit's worth $10,000 in your pocket. A $10,000 tax deduction might be worth somewhere between $1,200 and $4,600 in your pocket, depending on your tax brackets and the state that you live in. But if it's an actual tax credit, it's worth even more. So definitely take advantage of every tax credit that you might be eligible for. And one of the tax credits that you may not be eligible for this, but it's very possible your kids and your grandkids is the saver's tax credit. Those who have a very low income level, so think of like kids or grandkids that might be in college, might be doing a little part-time job on the side. They're not making a lot of money yet for these early years in their career. Help them make a small contribution to a Roth IRA each year so they can get that saver's tax credit. And it'll actually be almost as if the money coming back from the government is reimbursing them for a large part of their contribution into a retirement account, because that's the way that's one of the underutilized tax credits that's out there. And there are some other tax credits you want to lean into, but yeah, just that's some insights. As far as tax deductions are concerned, there are 5 big tax deductions that we'll usually talk about with our clients. I think you'll probably find value in this, so I'll share those 5 with you really quick.
Please, yeah.
One is qualified retirement plans. That's probably the low-hanging fruit, easy button option. If you have a 401k plan or a SEP, often self-employed pension plan, SEP IRA. Simples, KIOs, these kinds of qualified retirement plans are attached to your employment. If you're self-employed, then you have the responsibility or the opportunity to create your own qualified retirement plan. And there's limits to how much you can put into these things each year. But 401ks, you can stick in, if you're 50 years old or older, $31,000 this year. Plus, you can make a profit-sharing contribution on top of that, up to 25% of your net Schedule C earnings minus 1/2 of self-employment tax. Or if you have a W-2 wages, 25% of the wages. Again, that's in addition to the $31,000 contribution. If you're under the age of 50, then it's $23,500. Is that right? Yeah, $23,500 this year in 2025 for contributions. Those limits change each year, so you'll want to take a look at that. IRAs and Roth IRAs kind of fit in that same category, even though they're not technically qualified plans. It's something that you would want to take a look at as well, some ways to get some potential tax deductions there. But that's the first of the 5. The second one, the interest deduction on your home, is one of the things a lot of times people will think about. Your primary residence, you can write off up to $750,000 of the mortgage on your primary residence. The interest on that you can take as a tax deduction on your Schedule A, your itemized deductions. But the itemized deductions gets interesting because you're actually comparing your standard deduction, which is basically a free deduction everybody gets, versus your itemized deductions. And if your standard deduction is higher, then your itemized deductions don't really count. And one of the things that they did with the Tax Cuts and Jobs Act just shy of 10 years ago was to actually increase the standard deduction so significantly that most people don't get to write off their Schedule A itemized deductions anymore. Most people are actually just taking the standard deduction and they're not itemizing, which means that interest on their home is no longer adding value on their tax return. So it's no longer a tax deductible benefit. And if that's the case, you might want to look differently at your mortgage. Your mortgage might be less valuable to you than you used to believe it was. Then again, if you locked in an older interest rate that you can't find today, it might be extremely valuable. So don't jump to conclusions, but all these things should be factored into your thought process.
Yeah.
So that's first one, qualified plans. Second one, interest on your home mortgage. Third one, kids. You want to have kids? That's great. You can get a deduction for the kids as far as the number of dependents in your household. They are not profitable. I know that firsthand. I love my kids, but there's no way to make money by having kids. So I don't encourage you to have kids to get tax breaks. But it is something, your number of dependents are going to be a deduction for you in there. Charitable contributions, again, great if you want to do this. Pay attention to your itemized deductions that year because it does end up as an itemized deduction on that Schedule A. And we definitely have a lot of strategies around optimizing your tax breaks for charitable contributions. If you're over the age of 70 years old, 70 and a half, you're eligible for what are called qualified charitable distributions, QCDs. And that's definitely something to take a look into, especially if you have a standard deduction on your tax returns. You might be able to get a higher benefit associated with QCDs by doing that instead of just writing checks for your charitable contributions. Mm-hmm. And then number 5, is business expenses when you own your own business. So if you own a business on the side, a little business or a big business, you have expenses and you only have to pay taxes on your profit in the business. So all of the expenses that are related to your business are things that you get to subtract from your gross revenue, and then you only pay taxes on the net profit of the business. So all of the expenses for your business are things that you can also take tax deductions for. So there's the quick 5. There are certainly a whole bunch of other ones, but those are the big 5, I'd say, that you think about. Like, I don't know. I'm not a hunter, but they talk about hunting with your camera for the big 5 when you're in Africa. Like it's funny. I don't know why it is. It was like elephant, giraffe. That'd be an interesting trivia question. What are the other 3 big ones? I think it's like a hippopotamus, rhinoceros, and I don't remember the other one. But yeah, with your camera, you always are looking for the big 5. So I wonder what the 5th one was. A lion, probably the lion.
Probably lion.
That makes sense.
Yeah.
So this is the big 5 tax deductions. So hunt for those instead and decrease your tax bill. So what else you got? have for us today,
It's
Tyler?
so obvious which topics we choose on the Clear Money Talk that excite us each. There's some that I do most of the talking, and I'm all pumped about, and then this one I'm just tuning in, man, tuning into you. I love it. I didn't want it any other way. I hope the viewers are getting a lot of ROI out of this because there's a lot of meaty stuff, a lot of good stuff here.
Yeah, there's a lot. I'm trying to give you the really the top level tip of the iceberg.
Start preparing yourself for just the answer, Tim, because I'm going to need you to keep that tight.
I understand. I'll do what I can. I'll do what I can.
Let's talk about adjusting withholdings. So
sure.
If Tim talked a little bit earlier, if you are somebody that maybe doesn't perfectly align their tax return with their withholdings, like maybe you're getting too much back as a return, or maybe you end up owing too much as a return, it might be worth giving consideration to adjusting your tax withholdings, whether that's filling out a new W-4 for your employer, adjusting your tax withholdings from your retirement accounts if you're drawing from taxable retirement accounts or otherwise. But that's another thing to give consideration to when you're trying to maximize your tax return. And now it's a great opportunity to do it because you're going to be filing for 2024 taxes right now. You can see how that ends up. So that way you have plenty of time between now and filing for 2025 taxes next year to make any needed adjustments. And I recommend making adjustments if it makes sense for you and not just to ignore it.
Yeah, no, absolutely. Spot on, Tyler. You're correct. I mean, if you got a really big refund this year and you're like, that's dumb, they're holding on IRS, holding on to my money, you can always adjust your withholdings, withhold a little bit less. On the other hand, if you owed some money this year or your refund was really close and that was stressing you out, you might want to withhold a little more money. And so withhold a little more from your paychecks and prepay a little bit better. There's also what's called a safe harbor. Safe harbor basically means, hey, if you pay this amount, we're not going to hit you with interest. So the IRS says, if you give us this much in advance this year, and then you end up owing more next year when you file, we're not going to charge you interest on that. Remember I said if it's over $1,000, they're going to hit you with interest? Well, there is something called a safe harbor that says, well, what if you just roughly, if you pay the same amount of money you owed the previous year, and you pay that in advance, and then you end up with, like, what if you win the lottery in December, or you get a huge bonus in December, or just have this huge unexpected tax consequence in December? You didn't know that was coming, and you didn't prepay your tax bill for it. So if you end up owing taxes on that come April 15th, just a few months later, it's not fair to get hit with interest on that huge difference, right? So the IRS says, hey, as long as you prepaid a certain amount, it tends to be 100% of the previous year, or I think if you're at higher income levels, it's something like 115% of the previous year. So take a look at the safe harbor for prepaying if you're worried about some big unexpected windfalls of income that might come in and ultimately affect your taxes owed, and then that may have an impact on the interest, because you don't want to pay interest to the IRS if you can avoid it. Yeah, good point. But anyway, that was a side tangent. I feel like I'm down a rabbit hole.
No, it's good.
Pull me back out of that rabbit hole,
I got
Tyler.
you.
Where are we going?
Two more things. Avoiding common filing mistakes. So working with someone like an advisor or somebody that's a tax professional, we try to help you as a listener, as a client, whoever you are, avoid common mistakes, whether it's investing money, which is what we do, whether it's a common tax filing mistake, maybe you're a tax preparer or otherwise can help you avoid those things. You don't want to fall into a hole if you can know the hole's coming, right? We talk about that often on the podcast. So Tim, with your experience, you got more experience when it comes to taxes than me, like generations more. Tell me.
Thanks for the age commentary, Tyler.
No, it had nothing to do with age.
I'm feeling really old right now. That's good. That's solid. Okay, generations more experience.
Take it how you want. Take it with a grain of salt. Come on.
I do have some gray. I have some gray here, a little bit of the gray.
I got
beard.
some
I get it. It's fine.
too.
I can deal with it. And I have less hair. I have less hair and gray. That's
because of all the energy and knowledge radiating out of your head,
shining off my head,
burning
those hairs off. All right, go ahead.
Common tax filing mistakes.
Common tax filing mistakes.
I can think of a few really quickly, but
go for it.
the most common one, just filing late and, not being aware of the deadlines. And especially, I think it's April 15th, whatever it is. Sometimes it falls on a weekend or whatever. It's one day before or after. But roughly the middle of April is tax filing deadline. That's when you have to pay your estimated tax payments and your dues, whatever your invoice is. You need to make sure those are paid by that time. Even if you file an extension, that doesn't mean you get more time to then pay your taxes. You still are supposed to pay what you need to. Tim can probably fill in a little bit of clarity on that for me.
Yeah.
But trying to make sure that you meet that deadline as far as paying those taxes, what you owe, but also just filing your return in general. If you're not going to be able to file it, make sure that you get an extension filed at least by that deadline. That's one common thing. One other common thing is not waiting until you have all your tax forms that you need. So this happens all the time with 1099s. K-1s, other tax forms that, might be more ancillary depending on your situation. W-2s, if you had multiple jobs, make sure you have everything before you go ahead and file, because what you don't want to have to do, it's not the end of the world, I guess, but you don't want to have to file an amendment if you don't have to. It's extra time, sometimes extra money, and you can just avoid that altogether if you just make sure that you're totally prepared before you click file or return, or before you hand over everything to your tax preparer and say, this is everything.
That's right, yep.
Yeah, missing out on qualified retirement plan contributions is another big one. So, the IRS gives you a little bit of leeway specifically for individual retirement accounts, things like traditional IRAs, Roth IRAs, certain qualified employer retirement plans also give you a little bit of leeway, being able to actually contribute up till the tax filing deadline for the prior year. So just because maybe you didn't max out your retirement account, even though you had intentions to do so by December 31st, maybe you still have a little bit of flexibility and time to get that done. If that's something you want to do, just know that you have a little bit of, safe harbor to get that done and still have it qualify for that prior year. So
yeah, no, those are really good ones, Tyler.
Yeah.
So don't file late or you get hit with penalties. That's in addition to the interest.
Yeah.
So make sure you file on time. Remember, you can always amend it later if you feel like you need to file and hit that date. Then you have 3 years to amend it to fix it if you feel like you don't have all the information, just in case. And then the second one, try to have all the information available to you if you can. If you have to file an extension, file an extension. You file an extension, it gives you more time to file that return. But remember that just because you filed an extension and you might file the return on September 15th or October 15th, depending on if it's business or corporate, you can usually get an extension to that. It does not give you the right to pay money owed later than April 15th. If you owe that money, you want to prepay that before the April 15th cutoff to avoid the interest. Otherwise, they will hit you with interest on that money if, even though you filed an extension. But you don't get hit with the penalties for filing late, which is the other thing you want to avoid. So just make sure you file. So you're spot on with those recommendations, Tyler. I felt what was the third thing you said? It was really good.
Qualified retirement account contributions?
Yes, that's right. So there's a little bit of FOMO there. The other thing to remember with that is December 31st is a cutoff for making contributions to maybe your 401k through your employer. And if you're self-employed with an S corp or a business where you have a corporation or an LLC that's taxed similarly, and you have a paycheck, wages, you also have to withhold that by December 31st and get that submitted as far as your wages. But if you're self-employed and you have a Schedule C for your business, or something along those lines, think of a lot of realtors or any kind of self-employed contractor where they may not have a business set up as an S corp or an LLC yet. You actually have until your tax filing deadline plus extensions to make that contribution for the previous year. So you could actually have all the way until September of the following year to contribute to a qualified retirement plan account for the prior year. And that's something that you may or may not be eligible for. But if you're self-employed, you may have that shot, especially the profit sharing kind of contribution that you might be able to make. So if you're trying to still reduce your tax bill for last year and you filed an extension by the time you hear this and you're self-employed, check, give us a call because we might be able to help you out. And as long as you get a hold of us, before the end of the summer, to actually decrease your tax bill for last year, because there are still some things you can do in that qualified retirement plan.
So what happens in that case where you have to prepay your taxes by the tax filing deadline, middle of April, whatever that is, and then you're like, shoot, I could just make a whole big 401k contribution for the prior year, and then that reduces my bill, and all of a sudden the IRS now owes me money opposed to me having owed them money. Then you just get your tax return later, or you get a refund later, I guess?
Yeah, you get your refund later when you file. That's
nice.
Right. So instead of, if you can estimate that before April 15th, and if maybe you estimated that you were going to owe that extra money, so you prepaid a bunch of money, what if we could turn a bill that you just paid by the time you hear this into, you get all that money back and a refund? How cool would that be? Well, every year that goes by, once it's done, it's done. So that's it's cemented and locked in, and then once you get past the 3-year amendment period, you can't even go back and change that. It is what it is. So every year you want to try to work to get that tax bill to the legal minimum. If you just love our government, which by the way, there are some people out there that just really love our government. I appreciate that. If you love our government, you could always give them extra. They will take extra donations. They literally, there's law that says it's okay to send extra money to the IRS, the Oregon Department of Revenue. They'll take donations just like charities. So get your tax bill to the legal minimum, and if you want to send them extra, that's fine. But let's make sure that we're paying the legal minimum as far as what our bill is concerned. So,
yeah. Last point to talk about, Tim. When does it make sense to not do it yourself any longer, to consult a professional, to get somebody to help you prepare and file your taxes, to stop using the software yourself at home on your laptop and pawn that responsibility off to somebody that maybe has more expertise or more knowledge in that scenario and can generate higher ROI for you on that stuff.
I think the answer to that is as soon as you can afford it.
Yeah.
If you're struggling to make ends meet and just trying to put food on the table and just surviving, doing tax return yourself is maybe one way to save a little bit of money, or using a software program that might be very inexpensive. There are a lot of resources out there to help. There's even some nonprofit voluntary resources to assist you with completing your tax return, which shouldn't cost you anything, because obviously everybody has to get it done. But yeah, if you can hire a professional, usually the way I look at it when you hire an accountant, because even me, I can do my own taxes, but I don't do my own taxes. I pay an accountant to do my taxes for me and review all that stuff, because I know that second set of eyes on my tax return is going to be very valuable. If I add up the total amount of money that I pay my accountant each year, and I look ahead for the next 5 years, and I add all that up for 5 years, is it likely my accountant is going to save me at least that much somewhere in one of those years, because they'll see one thing that I didn't see? I believe the answer to that's yes. They may not save you money every year, but over a period of 5 years, there's a good chance they'll find enough opportunities to save you tax dollars to offset their cost over that entire period of time. And that's the way that I look at it. Plus, generally speaking, it does have a tendency to decrease your odds of an audit if you have a tax preparer signing off on that. And none of us really enjoy audits. At least I haven't met anybody who enjoys audits.
I haven't either.
Yeah. Well, we got to move to that. This is going to be a long one, and
That's
I could
okay.
ramble forever. So let's go with the just the answer.
We keep them all pretty
quick.
tight, so we can go a little bit long in this one. Let's reiterate the topic for just the answer. It's: are you maximizing your tax return this year? Tim, take it away.
All right.
Let me give you the bullet points we talked about.
Please.
Understanding tax refunds.
Okay.
What did we talk about there?
Okay. So understanding tax refunds. That's when so I guess the real quick recap is: your tax return is an annual true-up. What you prepay gets set up against what you owe at the end of the year when you do your true-up, when you fill out your form. If you prepaid extra money, you get that back as a refund. If you underpaid, you owe that money. That's it in a nutshell. What's number 2 for just the answer?
Common tax deductions and tax credits. You talked about the 3 different ways to have others help you with taxes, and we also talked about the most 5 common tax deductions / credits.
That's right. And you really should listen to the whole show to get the details associated with this, because I'm going to go really tight on this. So the 5 big tax deductions, we compared it to the big 5 in Africa when you're trying to go to Africa and see the big 5 animals. The big 5 tax deductions that were out there: qualified retirement plans, interest deduction on your home, which may or may not be adding value for you right now. You got to look into that. Charitable contributions, kids, neither of which you can make money doing, but it's great to have them. And then business expenses if you own your own business. Those were the big 5 tax deductions. And then the 3 ways, thing we don't do is tax preparation. We do tax planning and tax management. We talk more about the differences between those 3 things in the full version.
Yep. Adjusting withholdings.
Adjusting withholdings, yes. So if at the end of the year when you file your taxes, if it turns out you got a really large refund, the IRS was making interest on your money, you might want to adjust your withholdings and withhold less so that you don't get such a big refund the next year, so that they're not making interest on your money. You actually get it back a little earlier. Alternatively, if you owed a bunch of money, make sure you're withholding more this next year so that you don't end up with a big fat bill.
I like it. Avoiding common filing mistakes.
Yes, and then we went into common filing mistakes like forgetting to file and then getting hit with penalties for late filing or not filing, as well as missing out on 401k qualified retirement plan contributions. And let's see, the second mistake was
not waiting to make sure you had all your tax forms.
That's right. Yeah. Making sure you have all the information, otherwise you accidentally end up going back and amending that. And there's a lot of other mistakes that we've seen over the years. Those are just a few examples.
Yep. And when does it make sense to seek professional guidance on taxes?
And the answer to that was as soon as you can afford it. If you can afford to pay a professional, evaluate their services over like a 5-year period. Don't expect to save money with that tax preparer every single year, but over a 5-year period, there's a good chance they're going to find something that allowed you to save enough money to offset their cost for that entire 5-year period.
Yeah, well said. Every podcast we do is a little bit different. Some, the Just Answer covers it well enough where you could just listen to that if you want to and just do it quick and move on and you get the gist of it. This one, I highly encourage you, if this topic is of interest to you, if you feel like you're going to get any benefit from this topic specifically, listen to the full podcast. I highly recommend that. Tim talked about a lot of meaty, important, detailed stuff that when it comes to taxes, it might be able to save you a little bit of money or avoid a common mistake that you might be heading towards right now. So please check out the full podcast if you have time for it.
Yep. Before we move on really quick on that comment, just to piggyback the last little thing, also realize there are a lot of really advanced, cool tax deductions that we didn't even come close to touching on this podcast. Just because you didn't hear about it here doesn't mean we don't know about it. There's a lot. This is like an iceberg. We gave you the top 15%, some really good detail in there. That bottom 85% is under the water and specifically there to help clients if they need help. So if you think you want to pay less in taxes, you should give us a call and we should have a conversation.
Yeah. Yep. We only have so much time on these podcasts to talk about much stuff and trying to make it as applicable to everyone as possible.
Absolutely.
Yeah. Trivia.
Let's move on. Trivia it is. Wrap it up. What do you got for me?
Which U.S. president introduced the modern federal income tax system with the signing of the Revenue Act?
Oh my goodness.
Let's see how much of a tax nerd you are.
Oh my gosh. I don't. I really.
I can give you
know.
some.
I feel like
multiple choices. Yeah.
I mean, I remember that income tax is really. Yeah. Okay. All right. I feel like they really ramped up. I've seen the history of how high income taxes got. And you know how much they've come down since then, but like when they started and which president started them, I don't remember off the top of my head. Give me my multiple choice.
All right, Abraham Lincoln, Theodore Roosevelt, Woodrow Wilson, Franklin D. Roosevelt. I like how they throw two Roosevelts in there just to really trick you.
Teddy and Frankie, or Franklin D. Roosevelt. I don't think he went by Frankie, but
he let me call him Frank, but you know, it's cool. Yeah.
Well, everybody's got those relationships, those nicknames. That's fine. I'm just going to go with Woodrow Wilson. I have no idea why. Just that was my gut.
Spot on, man.
Oh, nice.
Yeah,
okay,
it was
good,
Woodrow.
Good. I'll take it. Little WW. I'll keep that in mind.
I couldn't tell you one fact about Woodrow. I'm sorry. Listeners, if you're big president buffs, I'm sorry. I don't know anything about Woodrow Wilson. Well, I do now.
Now we do. Yeah.
Now,
he signed
we know one thing.
He made us all pay taxes. Yay.
There you go.
How's that for
Thanks,
a legacy?
Woodrow. Yeah.
All right.
Thank you, guys.
We hope you really enjoyed Clear Money Talk today. May the clarity of financial circumstances create more wisdom for you, save you some money, make you some money. And if you learned something smart about money, please go to somethingsmartaboutmoney.com and get counted. And if we can help you further, reach out, get a clarity call. We have a little 15-minute call with anybody that reaches out, wants to have a conversation and see if there's a good fit opportunity. You can reach us at 503-579-1000.
That's right. Yeah.
Cool. Until next time.
Till next time. Sounds good. Looking forward to it.
Tim Clairmont and Tyler Andrews are investment advisor representatives offering securities and advisory services through Ceteri Advisor Networks LLC, a broker, dealer, and registered investment advisor, member FINRA SIPC. Ceteri is under separate ownership from any other named entity. The views depicted in this material are for information purposes only and are not necessarily those of Ceteri Advisor Networks LLC. They should not be considered specific advice or recommendations for any individual. For a comprehensive review of your personal situation, always consult with a tax or legal advisor. Neither Ceteri Advisor Networks LLC nor any of its representatives may give legal or tax advice. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Examples referenced are hypothetical only and do not represent the actual performance of any particular investments. Converting from a traditional IRA to a Roth IRA is a taxable event. A Roth IRA offers tax-free withdrawals on taxable contributions. To qualify for the tax-free and penalty-free withdrawal or earnings, a Roth IRA must be in place for at least 5 tax years, and the distribution must take place after age 59.5 or due to death, disability, or a first-time home purchase up to a $10,000 lifetime maximum, depending on state law. Roth IRA distributions may be subject to state taxes. Distributions from traditional IRAs and employer-sponsored retirement plans are taxed as ordinary income and, if taken prior to reaching age 59.5, may be subject to an additional 10% IRS tax penalty. Investors should consider the investment objectives, risks and charges, and expenses of mutual funds and ETFs carefully before investing. The prospectus, which contains this and other information about the funds and ETFs, can be obtained directly from the company or from your financial professional. The prospectus should be read carefully before investing or sending money. A diversified portfolio does not assure a profit or protect against loss in a declining market. Dollar cost averaging will not guarantee a profit or protect you from loss, but may reduce your average cost per share in a fluctuating market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Although it is possible to have guaranteed income for life with a fixed annuity, there is no assurance that this income will keep up with inflation. There is a surrender charge imposed generally during the first 5 to 7 years or during the rate guarantee period. There is a surrender charge imposed generally during the first 5 to 7 years that you own the contract. Withdrawals prior to age 59.5 may result in a 10% IRS tax penalty in addition to any ordinary income tax. The guarantee of the annuity is backed by the financial strength of the underlying insurance company. Investment sub-account values will fluctuate with changes in market conditions. An investment in a variable annuity involves investment risk, including possible loss of principal. Variable annuities are designed for long-term investing. The contract, when redeemed, may be worth more or less than the total amount invested. Variable annuities are subject to insurance-related charges, including mortality and expense charges, administrative fees, and the expenses associated with the underlying sub-accounts. Investors should consider the investment objectives, risks, and charges and expenses of the variable annuity carefully before investing. The prospectus contains this and other information about the variable annuity. Contact Clear Financial Partners at info@clearfp.com or 503-579-1000 to obtain a prospectus, which should be read carefully before investing or sending money. The cost and availability of life insurance depend on factors such as age, health, and the type and amount of insurance purchased. Before implementing a strategy involving life insurance, it would be prudent to make sure that you are insurable by having the policy approved. As with most financial decisions, there are expenses associated with the purchase of life insurance. Policies commonly have mortality and expense charges. In addition, if a policy is surrendered prematurely, there may be surrender charges and income tax implications. Clear Financial Partners is located at 15573 Bangi Road, Suite 100, Lake Oswego, Oregon 97035. For more information, please call us at 503-579-1000.